Dear students, coming back to financial management, capital budgeting portion. In the last few videos, we had gone through various non-discounting and discounting techniques used in capital budgeting. Taking the first notes, I am putting a review that non-discounting techniques we had gone through problems of payback period, average rate of return, both with regular cash flows and mixed cash flows. Then discounting techniques also we had gone through problems with regular cash inflows and mixed cash inflows, where the method covers discounted payback method, net present value method, internal rate of return method, profitability index and terminal value. All these methods we had gone through problems in the last few videos. Now the portion which is left as per your syllabus is capital rationing and risk analysis in capital budgeting. Today's class I will be dealing with these two things: capital rationing and risk analysis in capital budgeting. When coming back to the basic class of capital budgeting, I had told that there will be 4 types of investment decisions in capital budgeting: mutually exclusive investment decision, independent projects, contingent investments and capital rationing. So connecting back those theoretical portion. What is mutually exclusive investment? Taking one project will exclude the other projects. When we have 5 projects in hand, choosing one project will automatically exclude the other project. That is mutually exclusive investment. Independent projects are those projects where each project do not compete with one another. Different projects are different purposes. So sometimes we may choose 2 or 3 projects or depending upon. So that is what independent projects. So it will not exclude, choosing one will not exclude the other project, that is independent project. Third one is contingent investment projects, which is a part of capital budgeting. That is, choosing one will necessitate all alternate investments. For example, building up a factory in a remote area or village will necessitate building up of schools, quarters for the employees, medical facilities for the employees, etc. That is contingent investments. And the fourth one was capital rationing. Capital rationing is a situation where the capital which we are in hand is limited, but opportunities are abundant. So that is the situation what we are saying. So what is it? Capital rationing is a situation where limited funds are there, or capital in our hand, budgeted capital in our hand is limited, but investment avenues, abundant investment avenues are there. So we could go into in detail today's session what is capital rationing. As I told, it's a situation where budget ceiling is placed on the total size of capital expenditure. I am reading the points first. Budget ceiling is placed on the total side of capital expenditure. Selection of an investment proposal will be based on the availability of capital funds. It depends upon the funds, which project we have to choose. That is the meaning of the second point. Then abundant opportunities are there, where funds for investment is limited. And some of the opportunities have to be foregone, where IRR is above KO. That are the 3 points regarding capital rationing. Rather than reading this theory, I will explain like this. Suppose we have around 10 crore capital in our hand, where we will first find out which project we have to invest. We will choose various projects, which project we have to invest. There will be lot of investment avenues for us where the return is very high, but we cannot take all the projects together. So what we do, according to the capital, according to the return, we will invest. That is a situation where, so 10 crore is the capital in our hand, budgeted capital in our hand, but opportunities are there for 100 crores in various avenues where the return is very high. Such a situation is capital rationing. Now you could see that there is a fund shortage, but opportunities are abundant. Why this fund shortage come? It is because of 2 factors: external factors and internal factors. External factor, what are the external factors? Because of the macroeconomic condition, what happens? The fund shortage may arise. For example, inflation is very high. It's not the right time to invest. The project cost will be very high. Such factors may arise. Imperfect capital market. We do not know much. We do not get much information from the capital market about the profit viability, etc. That is imperfect capital market. Okay, such situation also arise. There will be fund shortage. There will be sometimes internal factors like, for example, reluctance in finance through external equities. That is, the company, in the case of the example which I had mentioned, 10 crore is the investment or the capital in our hand, where 100 crore is the investment avenues which is in front of us. We could raise easily through external equities, but no, we won't go for external equities because what will sometimes dilution may happen inside the company. That is, our ownership may get diluted. So that is the reluctance in finance through external equities due to sometimes we will fear of the risk. We will have the fear of risk. If we are investing in this time in a project where the profit is very high with the limited funds, whether there will be any for example, you could see in the COVID situation, the return from many companies are less. So just before the COVID period, people who had invested, the return may not come now. So that risk had arisen. So that reluctance may happen sometimes. Reluctance in broadening the equity shares. Some companies will not issue further shares for raising funds because further issuing of the shares may sometimes come into a situation where there is loss of control of the organization. We may invite private equities and all. Sometimes we may lose, the board of governors may lose their control over the business. So that is another internal factor. Sometimes inability to manage will be there. Some people may think that investing in various avenues where they are not expertise, they may not go for investing because they know well that they are not expertise in that field. There will be inability to manage. That is another internal. So various internal and external factors are there when a company go for investing. Even though they have fund and investment opportunities are abundant, they will not invest because of these external and internal factors. So what the company will do? In such situation, which situation, that is 10 crore capital. In our example, 10 crore capital is there. 10 crore INR capital is there in our hand. Projected capital is there in our hand to invest, where the investment avenues are 100 crores. We cannot invest in the 100 crores because we have only 10 crores. So we will take the investment decision in a judicious way. What we will do, we will budget the capital. We will calculate the return based on various discounting and non-discounting techniques. Sometimes we may use profitability index. Sometimes we may use IRR or NPV and find out whether the return is positive. And we will rank the projects. So, if 10 crore investment avenues are 100 crore investment opportunities are there, we have to go through these steps. Budget the capital, find out the IRR or profitability index or NPV of all those things and rank it and choose the investment project whichever is feasible. Let us go through a problem in the capital rationing. See, look into the problem. I am going through the question. CTS, Cognitive Technology Solutions, one of the biggest IT firms, proposes to invest in a divisible projects available for the period 2021, where the total funds available for them are 3 lakh crores of Indian rupees. So CTS is having a total capital of 3 lakh crores of INR. Okay. And there are various projects in front of them. It's a software company, IT company. They have different projects in their hand. Proposal of projects. It's not project implementation, proposal of projects which they are going to invest in various countries. You could see Project A, Amsterdam. Project B is in Kenya. Project C is in Vienna, Austria. And Project D is in Italy. And Project E is in Rio de Janeiro. It's in Brazil. So various countries they have projects where the proposed initial investment in crores are given. Okay, that is the project cost is given. it's an IT company, so they have a project plan submitted by various companies. So the project plan proposal cost is 1 lakh crores of Indian rupees, 3 lakh crores of Indian rupees. In Kenya, Vienna it is 50,000 crores. Italy it is 2 lakh crores of Indian rupees, and Rio de Janeiro it is 1 lakh crores of Indian rupees. So these are various project proposals in their hand, where their available capital is only 3 lakh crores. So available capital is 3 lakh crores, whereas the project proposal in various countries at the same time, that is very important. 2021 it starts at the same time. A lot of project available opportunities are there. So this is the situation, classic situation of capital rationing, where the fund is short but investment avenues are lot. That is, we have a lot of investment avenues. And other informations which is available in front of us is that profitability index of the project is given. We had studied already this thing, how to calculate profitability index under the discounting technique. Profitability index we had already covered. Then non-discounting technique and discounting techniques will be applied in the capital rationing problem. So profitability index is given in figures: 0.20, 116, 0.32, 0.125, 0.3, and NPV is also given. Net present value of the cash flow after tax is given 20,000, 35,000, 16,000, 25,000, 30,000 crores. So in here, what we do is that we will rank the project. How do we rank? We could rank based on the highest profitability index. The highest profitability index is, you could see this chart, the highest profitability index is for the 5 projects, the highest is 0.32 for Vienna. So we will take Vienna first. Then the second one is for Rio de Janeiro, 0.3. So we will take it as second. Amsterdam, it is 0.2. We will take it as third. And then we will take it, Italy, 0.125, and the last one is Kenya. So we will rank according to the highest profitability index, and we will rank it as 1, 2, 3, 4, and we will write what is the investment which is our project proposal cost. As Vienna is the first one, project cost is 50,000. Rio de Janeiro second one, project cost is 1 lakh. Then for Amsterdam it is 1 lakh crores, and Italy it is 50,000, 2 lakh crores. When we take this 4 project, we were not taking the 5th project. When we took the 4 project itself, our fund got limited. We have only 3 lakh crores. So what we had done for project 4 Italy, we had given only 1/4 choice. That is only 50,000. We limited our investment to 50,000. So within the capital, we chose 4 projects. Okay, so we could invest 4 projects judiciously by looking into the profitability index. We ranked it, and we invested in 4 projects with the available cash in hand 3 lakh crores. So this is the classic example of capital rationing. First problem, that is the investments in our hand is less, where the investment opportunities are more. So we will invest it according to the return using non-discounting or discounting technique, rank it, and invest within the limited available funds. So this is the example of capital rationing. Thank you.